Next session for today. With this age of information available online and the need for us to search for so many tax articles, so many tax case laws, we've become more and more acquainted with one website, which is taxsutra.com. Our next speaker is the executive editor and rather the co-founder of taxsutra.com, which is a lead. By Chamber of Tax Consultants, by the Bangalore chapter of IFA. He's also a visiting faculty at the ILS Law College, which is one of the leading government colleges in the country. On the subject of taxation again, he's a member of the subgroup of the ICAI on Base Erosion and Profit Shifting Project, which is BEPS project, and he has also co-authored articles in the Chamber's Compendium on International Tax and the upcoming Compendium on Transfer Pricing. He's also been a key member in books which are authored by Tax Sutra. With this, friends, let us extend a warm welcome to our speaker for the next session, Mr. Ameya Kunte. Before we proceed to his talk, I would request a member of our Delhi chapter, Mr. Dipendra Kumar, to present him with a memento as a token of our love and affection. Over to you, sir.
Thank you, Namrata, for this introduction, and thank you to Chamber for inviting me again. It's pleasure to be in Bombay and talk to all of you and share some of the experiences. So the topic over next 90 minutes that we are going to discuss about is domestic transfer pricing. The domestic transfer pricing, as you all know, was introduced just about a couple of years back, and in fact we all went through the first round of domestic transfer pricing compliance in November last year. So it's a relatively new law, but it draws upon significantly from the existing transfer pricing framework, and at least the basic framework is what you've already seen in last few lectures as a part of this course. So before I begin my my discussion on specifics around domestic transfer pricing, a quick poll: how many of you have actually signed 13CB dealing with domestic TP last year? Okay. Next question is: how many of you have prepared the domestic transfer pricing documentation either for last year or this year? Sometimes the question 1 and 2 are independent. That's why I specially asked. And how many of you have opened and read the new section around domestic transfer pricing? Okay, quite a lot. So let me give you let me leave you with a question right at the beginning of this session, and we'll try and discuss it at the end of our session. And this question is inspired from the recent adjustments that have happened in case of Shell and other cases. Do you think that the domestic transfer pricing provisions, is it an independent charging code by itself? Can you do a domestic transfer pricing adjustment dehors of what's written in section 40A2 or 80IA? Can a transfer pricing officer just invoke section 92 subclause 2A and make a transfer pricing adjustment under domestic TP? That's my question. We will deal with it after we go through some of these slides, but in case some of you have thoughts, you can gather your thoughts, and I'll be happy to hear your views as well. So I'll be focusing on the concept of domestic transfer pricing, the law on domestic transfer pricing, and then the specific aspect relating to 40A2 transactions. There's a separate session tomorrow covering section 80IA 8 and 10 transactions, so I will not go into the details of that part, but I'll focus on the basics and then 40A2 related transactions. So, coming back to the basics, why there is a need for transfer pricing. I think that's fairly well known. Last over 60 years of tax law, we all know that how loss-making taxpayers or assessees or entities are used to minimize the tax incidence. Since 1980s, when we had introduced the tax holiday provisions, Section 10A, Section 10B, series of deductions under Chapter 6A. Came with evil of tax avoidance, wherein you would attribute more profits to a undertaking which is which is eligible for tax holiday, and therefore minimize the tax incidence. I think some of these points are very well known, and people have indulged into some of these aspects, and therefore there is a clear need for something which sort of which protects the revenue base from these unscrupulous practices. One point on a conceptual level that comes to my mind is that after general anti-avoidance rules, GAR, come into effect from next financial year, let's hope that there is no further deferral of GAR in India. I think the scope of domestic transfer pricing, the way it is today, it is in a very narrow sense. I think conceptually, that scope perhaps may get further extended once GAR comes in, especially in case of tax avoidance transactions using loss-making entities or misuse of the tax holiday provisions. Is domestic transfer pricing new? Answer is yes and no. There are several provisions in the income tax law, which some of them have been there for last over 3 or 4 decades, are there, which in a way follow the principle of fair pricing or fair profitability. The two provisions on this slide are very well known and very obvious. 48.2, assessing officer has a power to disallow the expenses having regard to the fair value, legitimate needs of the business, benefits taste. In tax audit report every year we sort of test these transactions and report. We have several judgments which say that commercial expediency is what needs to be seen while deciding this disallowance. ATI 8 and 10, these provisions, especially after the transfer pricing was introduced, have come into limelight. What ATI 8 and 10 in simple terms say that if a tax holiday unit is earning more than ordinary profits or more than reasonable profits, then those excess profits will not be eligible for the deduction under Chapter 6A or Section 10A or 10B. 10A, 10B, of course, is now not there in the law. It's only SEZ units which are eligible for 10AA deduction. And of course, Chapter 6A covers several undertakings and which are still eligible for tax holiday. So as far as the STP EOU units are concerned, ATI 8 and 10 as such has no relevance today. But ATI 8 and 10 in effect again enshrined the principle of fair pricing, and that was there in the law. Other than that, at least there are 3 other provisions where the fair pricing concept is there in the Income Tax Act, and one more which I missed adding in this slide. The first one is famous 50C. What do you do in the land transfer? If the transaction value is lesser than the stamp duty value, the transfer assessing officer has a power to substitute the stamp duty value. I feel it's essentially a domestic transfer price relating to property transactions, of course, land and building. Same is the case with Section 56, which was recently introduced in the hands of the recipient. The second example that I could think of is the depreciation. Again, this section has not been sort of invoked or used many times, but if there is an explanation in Section 43.1 which defines the actual cost, and one of the explanations says that where the actual cost resulting in depreciation results in additional depreciation with the objective of reduction of tax liability, assessing officer has a power to recompute the actual cost. Sale and leaseback transactions is a classic example where some of these sections were invoked. Again, I feel this is a classic example of a domestic fair pricing qua asset acquisition, depreciable assets. Another point is value of any benefit or perquisite derived from exercise of business or profession. Now, these are not sort of cash or cash equivalent tangible receipts that a businessman earns, but the perquisite that results from business. You have to ascribe some value and bring it to tax under section 28. Again, in principle, it follows a arm's length principle or a fair pricing or a fair value principle. Another example, last year, continuing with section 50C, land transactions where the land is stock in trade in the hands of the builder. Again, the stamp duty valuation provisions were introduced, where land is held as stock in trade and bought by the builder. So in substance, there are different provisions in the income tax law even before domestic TP was introduced, which sort of look at the fair value principle. And that same concept has been now extended in a more elaborate manner when we come to the provisions of domestic transfer pricing. Glaxo judgment is the foundation, or I would say mother, which conceived this domestic transfer pricing as an idea. This is a Supreme Court judgment of July 2010 involving several Glaxo entities, wherein there were payments being made within Glaxo entities, and the disallowance under section 48(2) was being tested, and the matter went before Supreme Court. One of the key arguments in that decision was that all these transactions were revenue neutral. In a sense, one entity is making a payment to another entity. In the hands of the payer, you are seeking to disallow certain expenses. But if you look at in the hands of the recipient, fair taxes or the same amount of tax was being paid. So where is the revenue loss? That was a issue raised from the taxpayer side before the Supreme Court. This judgment is authored by former Chief Justice Kapadia, and in this judgment, Supreme Court has specifically observed that domestic transactions between related parties in certain situations may not be revenue neutral. So they have given two instances in the judgment. Use of loss-making entities, the example that we saw earlier. Also the tax arbitrage between transactions between two units because of, for example, tax holiday. We've seen that is a commonly adopted tool, especially windmill power generation units. It's relatively easy to do so. One more example that I could think of, very simple, is that directors, relatives, or wives who are entitled to use exemptions or enjoy higher tax slabs. There are instances where companies or partnerships make payments to these relatives, somehow try and justify they are at arm's length, but essentially it's a tax rate arbitrage which is being explored by the taxpayers in a way that overall tax revenue gets minimized. So Supreme Court very well recognized this fact, and therefore Supreme Court in its judgment recommended government to amend the provisions relating to section 48(2) or ATI 8 and 10 to empower the assessing officer to make the adjustment to the income having regard to the fair value. And two specific observations which have resulted into this law. Supreme Court suggested that AO may apply any of the generally accepted methods of determination of arm's length price, including the methods provided under the transfer pricing regulations. So this is what Supreme Court suggested, that today to apply a 48(2) disallowance, there is no specific guidance given in the Income Tax Act. All the officer has to do is consider the fair value. But what is fair value? I mean, you would have looked at in your professional experience and in this course that value is extremely subjective. So there has to be some method to this madness. Supreme Court said that bring some logic, some method, some system to determine the fair value, where the officer will be able to make the determination in a more objective manner. And also Supreme Court specifically suggested introduction of the documentation for which will help in determination of the fair pricing or fair value, and a compulsory audit of this documentation and evaluation in line with the normal transfer pricing. So this is what Supreme Court in Glaxo judgment, which came in July 2010, said. I think here we must give a credit to the government for acting extremely quickly in less than a 1.5 years time to take these observations and implement them immediately. And Finance Act 2012 introduced the provisions relating to specified domestic transaction (SDT), and we are loosely referring them as domestic TP or domestic transfer pricing. Any thoughts, any points, any comments so far? This is the backdrop of why domestic TP is there today. Sure. Sure, sure. Any other comments on this? By the way, India domestic transfer pricing is present in several other jurisdictions in the domestic law, and India is not the first one amongst the developed countries to sort of implement domestic TP. There are few other countries or many other countries which actually have a more elaborate domestic transfer pricing in their domestic provisions. One more. So Finance Act 2012. I think in last 10 years, Finance Act 2012 will be the most remembered budget as far as the tax provisions are concerned. You had Vodafone amendment. You have domestic TP. Several other important changes. So what the memorandum to the Finance Bill 2012 said about domestic transfer pricing is very important. Bring in the objectivity while determining income and reasonableness of the expenditure from domestic related party transactions. B, create a legally enforceable obligation to maintain the documentation. So what they meant is that in a 48(2) scenario or 80IA 8 scenario, there is no specific documentation that was prescribed. Now there is a legal obligation to maintain such a documentation under the domestic TP. And third aspect is create a monetary threshold of 5 crore rupees for avoiding unnecessary compliance and administrative burden. So again, their intent seems to be fair, that they do not want to burden taxpayers which have transactions which are below 5 crores with this additional compliance. Couple of other interesting points from the memorandum which I had later noted. By the way, 5 crore, what do you think? Is it fair? Is it too low? I remember last year when I spoke at this session, and I asked whether in the clientele that you have, how many would be having transaction value more than 5 crore, and I guess barely 10% of the audience raised their hand. So is that still the trend that is continuing? Is 5 crore a reasonable limit? What do you think? Those who feel reasonable can raise their hands. I feel it is reasonable. It's on the lower side. Okay. So very interesting point in the memorandum. It's also written that extending domestic transfer pricing to all the domestic transactions will add the compliance burden and therefore is not desirable. So therefore they first have restricted it to 48(2) and 80IA 8 transactions. So you will notice that the revenue side transaction, the sale transaction, normal sale transaction between related parties are generally not covered within domestic TP unless it deals with a tax holiday unit. Another point is specified in the memorandum is that there is no specific method to determine the reasonableness of the fair value, and therefore they are prescribing the methods. So this is the intention, or this is the object with which they introduced the domestic transfer pricing provisions. Again, some of these bullets on this point, on this slide, perhaps maybe could be the arguments for the question with which I started with. what is the status of domestic TP. So you may note this particular slide and consider it while giving your response at the end. So what is domestic transfer pricing framework? This one slide captures the gamut of domestic DP, and then in the subsequent slide we will go into the specific sections and try and go through word by word on certain provisions that are there under domestic TP. So domestic TP is applicable to broadly 3 categories of transactions which are there on the left side of the screen. The first one is undertakings to which incentive deductions are provided, 10AA, ATIA, ATIB, ATIAB, which is there, and that covers primarily 2 aspects, ATI 8 and 10. ATI 8 deals with inter-unit transfer of goods and services. So if there is a tax holiday unit and a normal tax paying unit within the same company, transactions between these two will be subject to domestic transfer pricing. The second aspect is transactions between entities having close connection. That's what is stated in ATI 10, and I'm sure you will deal with more details tomorrow. But these are the transactions which are primarily covered or to which domestic TP compliance is applicable. The second important aspect is the expenditure for which payment is made to the parties which are related parties and which are defined under section 40A2 clause B. And again we'll read the specific section, how it is worded and the potential scope for this section. And third aspect is any other transaction that may be specified. So they have left it open. Luckily for us, there is no such transaction that has been notified. My take, this is a personal view, I think in years time even the revenue side transactions will come under domestic TP, the way the trend is moving. So first test is that it has to be a specified domestic transaction, which is the box on the left side. Then the second and important aspect is the aggregate value of transaction if it exceeds 5 crores. So if it is below 5 crores, then it is not a domestic transfer pricing. One more point which is not there on the slide is that transaction should not be an international transaction. So first of all, it should not be an international transaction. You would have studied what is the definition of international transaction in first few sessions, and there is a specific relevance to this, and we'll look at one case study later. So it should not be an international transaction. Then it should be one of the items on the left box. And the third point is the monetary threshold. If the value exceeds 5 crore, then you are liable to comply the domestic transfer pricing related provisions. And what are the implications? Is that you have to determine the value or the price of arising from these transactions, or price of these transactions having regard to the arm's length price by applying the most appropriate method. Again, you would have understood or learned what is arm's length price and what are the methods that are there to determine arm's length price. These are in the context of international transactions. Second, and the most important aspect, is maintain the contemporaneous documentation before filing of the tax return. Third aspect, which as a chartered accountants maybe most of you will be happy, is that you have to get a certificate from a chartered accountant, and the new 3CEB that was released last year, which is now the filing of 3CEB is mandatory online. In that, certain additional disclosures around domestic TP also were introduced, and of course the deterrent, the penalty if you fail to comply with these provisions. So there's a 2% penalty which potentially could be damaging and fairly high. So let us come to the specific definition under section 92BA of the Income Tax Act. What it says is that transactions which are covered, the first item, and we'll focus now on 48(2)B, expenditure in respect of which payment has been made or is to be made to a person covered by section 40A2. Yeah, so this is the bare text of the section 92BA. For the purposes of this section and section 92, few other sections, specified domestic transaction in case of this is the last slide at the annexure, which I'm showing you on the screen. In case of assessee means any of the following transaction not being an international transaction, namely clause 1, any expenditure in respect of which payment has been made or is to be made to a person referred to in clause B of subsection 2 of section 40A. Then there are Roman clauses 2, 3, 4, 5, 6, and at the end it says, and where the aggregate of such transaction entered into by the assessee in the previous year exceeds a sum of 5 crores. Now, before I come to Roman clause 1, one question, and which is an important interpretation issue, is that this 5 crore limit, should it apply to each of the clauses separately? So clause 1 should be more than 5 crore, clause 2 should be more than 5 crore, clause 3 should be more than 5 crore, or in aggregate? Aggregate. My view is also the same, but there have been interpretations given that the way this and where the aggregate value of such transactions, so such, some people have interpreted to mean that it applies to each of the clauses, and therefore 5 crore limit should be qua each clause and not all put together. Just thought I should make this point in case such situation comes, at least in the assessment proceedings. This can be a good defense to save from the penalty risk. Now coming to 40A, again clause 1, any expenditure in respect of which payment has been made or is to be made to a person referred to in clause B of subsection 2 of section 40A. Okay, so if you break down this clause into different aspects, all it says is that it has to be an expenditure in respect of which payment has been made or is to be made. So that's the second aspect. And third, the payment should be to persons which are covered under 40A 2B. If I see this, if I read this again and again, somewhere the common understanding is that first there has to be a 40A2 invocation by the assessing officer, and only then domestic transfer pricing can be applied. If I read this clause independently, nowhere it says is that there has to be first invocation of section 40A2B. The moment there is a payment to the party which is covered under 40A2B, it is a specified domestic transfer. It is a specified domestic transaction, which means that all the implications get triggered, which also means that eventually transfer pricing officer has a power to determine arm's length price from this transaction. So at least for me, the important takeaway from this clause is that 92BA perhaps is independent of 40A2B. So even if you meet 92BA test, there could be certain situations where 40A could still be applied, and we'll see that, and vice versa. Any different views on this point? Right. So this is the sort of 92BA is the key section relating to domestic transfer pricing. Before that, let me sort of step back and also take you through the relevant wording of section 92. Section 92 is the this I think is on the previous slide. Section 92 is the key charging section relating to the transfer pricing. The section heading is that computation of income from international transaction having regard to the arm's length price. Section 92(1), you would have studied that, you know, any income from international transaction shall be determined having regard to arm's length price, etc., etc. 2A of section 92, what it says is that any allowance for an expenditure or interest or allocation of any cost or expense or any income in relation to specified domestic transaction shall be computed having regard to the arm's length price. So 92 2A is the section which sort of, if I may say so, an enabling section to apply the domestic TP. This section read with 92BA triggers all the actions which are there under the domestic transfer pricing. Let us come to now 48.2. As we saw, 92BA says that any expenditure in respect to the persons which are covered under 48.2. Let us first see section 48.2. Before we come to the specified persons, let us look at plain vanilla what section 48.2 says, where the assessee incurs any expenditure in respect of which payment has been made or is to be made to a person referred to in clause B of this subsection, and clause B is linked to the domestic TP, and the assessing officer is of the opinion that such expenditure is excessive or unreasonable. So the test is excessive or unreasonable, having regard to the fair market value of the goods, services or facilities for which the payment is made. So this is the first limb, that the expenditure is held to be excessive or unreasonable, or the legitimate needs of the business or profession of the assessee, or the benefit derived by or accruing to him from this transaction. So there are three different reasons why an assessing officer could invoke 48.2b. One is that excessive or unreasonable expenditure. B, which is independent of A, is legitimate needs of the business. And C, the benefit test, the benefit that is accruing to the assessee. Now this, if you compare with 92BA, 92BA does not have any such additional tests. All it says is that there has to be an expenditure to the persons who are covered under 48.2b, then domestic TP is applicable. For 48.2, there are three different reasons why an assessing officer can invoke the disallowance. The proviso is important. Provided no disallowance on account of any expenditure being excessive or unreasonable. So which is a clause A of 48.2, right? Excessive or unreasonable test. No disallowance on account of any expenditure being excessive or unreasonable, provided that no disallowance shall be made having regard to the fair market value shall be made in respect of specified domestic transaction referred to in 92BA if such transaction is at arm's length price. So if you satisfy the arm's length test under 92F, then your 48.2 disallowance vis-a-vis the first aspect at least gets addressed. So the point that I'm trying to put forward here is the interplay between 48.2 and your 92BA. If you satisfy the arm's length test under 92BA, 48.2b, the same arm's length price will be treated as a fair value, and you are saved from 48.2b. Having said that, even if specified domestic TP is not invoked, assessing officer could still invoke 48.2b, either on account of the first bullet or on the second point, which is legitimate needs of the business. What if assessing officer concludes that this expenditure is not for the legitimate needs? That is possible. So that's the point that I was trying to say, that SDT and 48.2 be interplay between these two sections. Any questions on this point so far? 92BA and my take is perhaps no, because you may be still at arm's length, but what if the assessing officer comes to the conclusion that the payment is not according to the legitimate needs of the business or profession? There are three different clauses in 48.2. True, but it starts with no disallowance on account of expenditure being excessive or unreasonable. So it only refers to A, part A of 40A2 and not B and C. So there is a scope for the assessing officer to still invoke 40A2B is what I'm just, as I said, these are, honestly, some of these discussions could be academic, but we as professionals should at least try and get the basics right. So that's why I'm sharing it with you.
In fact, I would believe that would not be academic because then in several cases of infractor transfer pricing also there have been instances where the TPO says it's at arm's length and then the AO tries to disallow under section 37.
Right. That's very well said. And a couple of other situations also we will see where even if 40A2 doesn't apply, 40A2 disallowance doesn't apply, you still have to meet the domestic TP test. That's an interpretation debate, isn't it? That should you apply excessive unreasonable to all three, or should you read three independently? Okay, appreciate. So that's right. Perhaps, unless it is contractually covered. Yeah. So his example is, I don't know if everybody could heard what he said, is that you could be reimbursing school expenditure of director's son, and that expenditure may be at fair value, but whether it is legitimate having regard to the business is a matter which is needs a subjective determination. So thanks for that example. Coming back to again the domestic TP. So you have 92BA, which says that the payment should be, the expenditure should be in respect of payment to be made to persons covered under 40A2. We have seen this list for years and years and years. The list of related parties that are covered. Should I go through all these limbs once again, or should I just focus on the key change that has happened last year? Key change, yeah.
And excessive. Are they synonymous? Are they different? What are they?
Right. True. I think you need to read both the words harmoniously together, and it's very difficult to say yes or no type of answer. And as I said, we have seen that many times the payments to directors' relatives have got questioned. So you demonstrate with the experience and so on and so forth, even in the normal assessments. Right. So you're sort of supplementing the arguments that our friend over there suggested, that you should apply it to all the three clauses. I would believe so. That's what the argument is. But there are, if you read some of the commentaries on domestic TP, this view has been put forward, and of course it will come up for testing in due course as the law evolves. So persons covered under section 40A2, we have company directors, their relatives, HUF members, AOP members, partnership, their relatives. You look at, in case of companies, you look at the directors and their relatives as well. One specific point, so these relations you are very well aware about, right? So I will proceed based on this assumption that all these parties which are covered under 40A2 are the parties which are well known. I mean, that we've seen it over the years. I will straight jump to one specific case. I'll then come back to other aspects around it. What is the beneficial ownership? We have seen beneficial ownership is to be tested qua the shareholding, and 20% is the threshold. In case of company, 20% equity. In case of partnerships and others, it's a profit power to derive 20% or more profits. In case of companies, there are two specific situations. Let us take this kind of a structure. A holds, let's say, 50% in X and 50% in Y. and there is a specified domestic transaction. Let's say X has made a payment to Y. Okay, whether this transaction will be, whether party X and party Y, will they be treated as a party covered under 48(2)(b? That's the question. Before Finance Act 2012, transactions between X and Y were not included in the definition of 48(2)(b related parties. So these transactions were out of 48(2) disclosures and compliance. But along with the specified domestic transaction introduction, they made one change in 48(2)(b, is this transaction between X and Y is also covered. So basically, transaction with a fellow subsidiary is a transaction which is to which domestic TP is applicable. Mind you, this also has a consequence on your tax audit disclosure. So that is independent of domestic TP. Yes.
But in a situation where suppose A is holding 60% in X and holding 30% in Y.
It would still be covered because it uses the word substantial interest. So
60 of X. So if you count 60 into 30, it is 18%.
right, so you don't look at the effective holding. Anyway, there is no effective holding between X and Y. A is holding 60% in X. A is holding independently 30% in Y. So A is able to de facto control substantial interest in both the entities independently, because the substantial interest threshold is 20% as far as 48(2) is concerned. No, it is not 18% because yeah. So if it is a second scenario, we'll come to the second scenario. I am on the left side box right now. Right. So transaction between X and Y will be subject to domestic TP, and as I said, 48(2)(b tax audit disclosure will also be therefore relevant. Now let's come to the second figure, the second diagram. A holds, let's take 60% in X, and X holds 60% in Y. The question is, and let's say Y makes a payment to A. The question is this transaction is a transaction which is between the entities which are covered under 48(2), and therefore whether domestic TP applies. So question is direct holding versus indirect holding. Right. So the way section 48(2)(b is worded, it talks about the a company holding substantial interest in another company. If you look at A, X and Y, A is holding substantial interest in X. X is holding substantial interest in Y. So therefore, indirectly for company law purpose and other purposes, A is holding substantial interest. But the way the substantial interest, at least in the tax context and in the 48(2)(b context, has been interpreted, you should look at the direct immediate shareholding. Similar issues or situations that we come across are in the context of section 79. Carry forward of losses, if there is a change in the shareholding, should you look at a direct immediate shareholding, or should you look at the eventual shareholder? And there the view that has been settled is that you look at the immediate shareholder and not look at the eventual shareholding. Same issue came up even in the Vodafone judgment, though in a different context, but it also sort of upheld the same principle. So you had an amendment subsequently in the different context, but the implicit point on direct shareholding has been seems to be well settled, and I must give a credit to the Institute of Chartered Accountants of India to sort of come out with such a explicit terms. The revised guidance note issued by ICAI last year in August 2013, there is a specific discussion on this aspect, and they have very clearly said that transaction between Y and A is not covered under 48(2), so you don't need to disclose it for the purpose of tax audit for sure, but this is guidance note on TP. They have said that these transactions will also not be subject to domestic TP compliance. They have they have analyzed a 1968 circular, they have analyzed various judgments and have given a view. So at least as members we can, if we are taking that view, we can very well give a reference to this guidance note in the notes to the tax audit report or to the 3CB that we prepare for the clients. For specified domestic TP purposes, yes. Unless you have a GAR situation where assessing officer disregards entity X, but just for domestic TP and 48.2 applicability, I think you will not be able to disregard the entity for the TP compliance purpose. I mean, courts can perhaps do it if they come to a conclusion that it was all sham. But I feel from the context of domestic TP, I think in at least 90% of the situations, this sort of this clarification will help. Right.
So beneficial still means that it has, I mean, if it is a shell company, then obviously beneficial holding is the A and not X.
Right, but you are disregarding the corporate structure. That's what I'm saying, which is a company, which is a separate legal entity. You are disregarding it. So I would differ with you. If it is an investment company and on paper, that doesn't mean it is a company without substance. You could have an investment company on paper with substance as well. But anyway, that's a separate debate. Your point is valid that what if eventually court says that X is you disregard X completely, and then whether penal consequences of not doing domestic TP will apply or not, those situations could arise. I don't disagree with you on that. I'm saying the law as it is today, and let us assume for the moment that all these entities are with substance, then domestic TP is not applicable. Another point is that, as I said, this substantial interest threshold is 20%. Whether this 20% is to be in case of specifically directors, if let's say you have multiple directors, each director holding below 20%, but collectively they hold more than 20% influence, whether they can be said to be having influence over the entity, and therefore whether domestic TP is applicable or not. Any view on this from any one of you? Whether you should look at individual director holding or whether you should look at multiple director holding. Let me just elaborate this a bit. Let's say you have X and Y. Forget A. You have three individuals who are directors on X and who are directors on Y. Each individual holds 10% in company X and Y. So both the directors, all three directors collectively are holding 30% in both X and Y. So would X and Y be entities for the purpose of 48.2? Does it matter, relatives? Okay, so they are not related to each other. You're right. If they are related, then you have to aggregate. If they are not related, yeah. So I agree with you that if they are not related, then such situation will be out of domestic TP. Then you need to aggregate the holding because the way section is right. You will have to then it may get classified under 48.2 and therefore SDT will become applicable.
So it means individual we have to consider, not aggregate.
The way it is worded is that I'm reading clause 4 in 40A to B. It's a very longish clause. I will skip few parts when I'm reading it. A company having substantial interest in the business or profession of the assessee or any director or member of any director of such company or any relative of such director, partner or member. And therefore, in case of father-son situation, you have a director whose father and his relative. I agree. It says that, so again I am reading that clause, in case of a company having substantial interest in the business of the assessee or any director or any relative of such director, if they control substantial interest. Okay, so I would read is in this case director or his relative, if they are exercising substantial interest, then you may get covered. But a director and another director is not envisaged in this clause. Maybe we can offline discuss on this point. We can go through the section once again. But this is the interpretation that I would put to 48.2. Right. Within relatives. Director and his relatives. So moving on, we saw 48.2 and the different limbs of it. So specified domestic transaction. Let us look at the key differences vis-a-vis a domestic transaction and an international transaction. We saw in the earlier sessions what is the definition of international transaction. International transaction means a transaction between two or more associated enterprises, and at least one of the two associated enterprises should be a non-resident. That is what we saw. That is what we saw as a definition of international transaction, which triggers the international transfer pricing. Domestic transfer pricing, any payment to party covered under section 48(2)(b, etc., etc. So what are the key differences? In case of international transaction, international TP, both income as well as expenditure side is covered. Under domestic TP, as far as 48.2 is concerned, it's only the expenditure side is covered. You don't test the revenue side. You test the revenue side only in case where you are eligible for tax holiday under 10AA or ATIA 8 or 10. So this is one fundamental difference between the two, that only in case of tax holiday entities revenue side is tested, not otherwise. Second aspect, and which is extremely critical, especially in the situation that you mentioned, for the international transaction, we studied the definition of associated enterprises, and there are different relationships that have been given. As far as the holding between the two entities is concerned, the threshold is 26%. Only then the two entities become associated enterprises. Whereas in case of 48.2, we have a situation where the threshold is 20%, right? So, so this is one important difference. As far as ATI 8 and 10 is concerned, there is no equity percentage that has been specified. All it says, ATI 8, as you would recollect, it says close connection. ATI 10, sorry, ATI 8 is within your unit, so there is no question of shareholding. ATI 10 says that close connection. So the entity may not even have any shareholding or cross-holding, but still domestic TP could be applicable. As far as 48.2 is concerned, meaning the expenditure in a normal situation is concerned, you have a substantial interest threshold of 20%, unlike in international transaction, which is 26%. And let me deal with a case study right here, since we are on this point. It's on the next slide. Let us say you have an entity A, which is an Indian company. Entity B is holding 23% in entity A or company A. Entity A is purchasing or importing certain goods from entity B. Is this transaction, so here entity B is a non-resident entity. It's not a domestic entity, it's a non-resident entity. do you think the international TP will apply, or domestic TP will apply, or nothing applies? Nothing applies. Those who feel yes can raise their hand. Nothing applies on this transaction. No TP applies. Domestic TP applies. How many of you believe domestic TP applies? So just 3 of you. And international TP, will this transaction be subject to international TP? Okay. Let me take you to 92BA. For the purposes of this section, following transactions not being an international transaction. So first test that we have to satisfy, is this an international transaction? We studied that international transaction is transaction between two associated enterprises, and definition of associated enterprise gives a threshold of 26%. So if I am below 26%, I am not an associated enterprise, which means that the transaction is not an international transaction, right? So not being an international transaction test is satisfied. So that third scenario is out. Moving on, following transaction, any expenditure in respect of which payment has been made or is to be made to persons referred to in 40A to B. 40A to B tells me that I should look at 20% substantial interest. Let me come back to the case study. Entity B is having 20% or more substantial interest in entity A. So as far as entity A is concerned, it is an expenditure because they have purchased the goods, imported goods from entity B. So this transaction will get covered under domestic transfer pricing. So the key takeaway is that while we say domestic TP, you could even have cross-border situations wherein domestic TP could be applied as well. I have one more interesting case study which will sort of make this point clear. It's slightly complicated in a permanent establishment situation. Let's take a situation. You have an entity A, which is a foreign company. Entity A has a branch in India, which we in normal situations call it as a permanent establishment, right? So entity A is having branch in India. One of the directors of entity A, to whom entity A is making salary payments and other payments, is deputed to this branch in India. Branch, as you all know, for income tax purpose is a non-resident. Branch is able to claim the deduction for the expenses which are attributable to branch's activities in India. So this director's salary is attributable to the Indian branch or Indian permanent establishment that company A has. Let's take a situation that this director is a non-resident person. So he's maybe operating from outside and only visiting India for the business purpose, etc. And he's being able to manage. So he is a non-resident essentially. So here you have a situation where entity A is making a director's remuneration payment to Mr. A, who's a non-resident. So it's a transaction between two non-residents. But the director's remuneration is charged to the permanent establishment in India or a branch in India. When you are computing profits of Indian branch, 40A2B is applicable. And here there is no question, perhaps there is no associated, let's for the moment assume that this is not an associated enterprise situation because of the, if that is the situation, you could potentially have a domestic TP also applicable for the transaction between two non-residents. So the key takeaway is that please test the relationships carefully and don't assume that domestic TP applies only if there are two Indian entities that are involved. So this is one key difference which is there. International transaction, you have benefit of unilateral as well as bilateral APA. Safe harbor provisions are also provided for and are available for the international transaction in case of specified domestic transaction, at least as of now, there is no unilateral APA, nor there is a safe harbor that is available. But I'm sure once this litigation grows, department will consider one day safe harbor for domestic TP as well. One key point is this deemed transaction concept, which was introduced in the international transfer pricing by Finance Act 2012. That is applicable qua international transaction. It's not applicable in case of specified domestic transaction. And we'll talk about few instances of this a little later. So any questions on SDT definition under 92BA, 48.2B? Any issues, any experiences that you have on this point before we move on?
The argument of SDT applying to cross-border transactions also, a plain reading of 92A, yes, there is no mention of the residential status of the parties involved, and therefore 92BA could apply to cross-border transactions, but then it defeats the purpose why SDT was involved. And I could always go back to the memorandum of explanation which says that it has to apply to residents as an assessee.
Sure. So if you look at the intent, perhaps yes, but finally you need to look at the provisions of the law, and unless there is some miscarriage of justice, I would say there is no
It does
reason why.
amount to miscarriage of justice.
Why?
No?
I mean,
something
all
that escapes international transaction is again brought into the net of transfer pricing.
No, I will put it the other way. See, you have 48.2 was always applicable or is always applicable, right? So there is no denying on that. What I'm saying, I'm just giving a counter to your view. 48 is always applicable. If you look at memorandum, what memorandum tells us is that domestic TP is giving you a method to madness, which is way to determine the fair value, which you anyway, assessing officer was well within his right to determine under 48.2. What if in a case study that we saw here, assessing officer comes to conclusion that the imports are at a higher price, right? So in my view, I think this argument probably will not be sustainable, at least in this kind of a situation. Yeah. Cover, right. It is not. You look at the definition of international transaction under 92B. What that definition says that international transaction means a transaction between two or more associated enterprises, and one of the associated enterprises has to be non-resident. Now, associated enterprise has been defined under 92A, which gives those 13 or 14 relationships. As far as the shareholding is concerned, the shareholding is 26%. Only then you become associated enterprise. So you are not associated enterprise. Therefore, this is not an international transaction, and therefore you fall under domestic TP.
Make a basket for catering these kind of a transaction, and we have created absolutely a separate chapter for international transfer pricing. So I think there would not be fair to test these kind of a transaction under the ambit of specified domestic transactions.
Okay, I respect your view. All I'm saying is that there is a counter that is also possible, and the way the section has been worded, it's fairly clear that domestic TP will apply in such situations. So perhaps after the session, once we complete this discussion, I will give few cases to you, and you can read the section and see that how disastrous domestic TP consequences could be in certain situations. Let us go through the topic that we have allocated, and then we can look at some unintended consequences of domestic TP, time permitting. So related party payments under 48.2, you have range of payments, purchases, procurement services, cost sharing, salary, director's remuneration, group recharge, reimbursement, guarantee fee, expenses. So you have vast nature of expenses which are being which are covered under 48.2, and therefore the domestic TP compliance is applicable for these transactions. Yeah.
It is not actually an expense, and therefore it is not covered.
So here you have to look at a situation that let's say I am a subsidiary. I am making a reimbursement of expenditure to my parent company, right? So here, as far as I am concerned, I have made a payment which is an expenditure to my holding company, and therefore it is strictly a domestic transfer. It is a SDT or a specified domestic transaction. Now the question comes is, how do you benchmark it? Correct? In benchmarking, I have to determine arm's length price by applying various methods. Luckily now we have a sixth method, for example, which takes into account, which helps us to say that in case of reimbursement, this is a third party cost. Assuming it is a third party cost, it meets an arm's length test. So there are 2 points. One is SDT applicable to you? Answer is yes, which means that you have to maintain the documentation. I'm assuming the 5 crore limit is also breached. It means that you have to maintain documentation. You have to file 3 CB. You may get, be scrutinized for that. Second aspect is benchmarking. So how do you benchmark reimbursement? Maybe it is fairly easy to say that it is a third party cost and therefore, or a pass-through cost and therefore it is at arm's length. But to say that the TP itself is not applicable, let's say there is a 10 crore reimbursement and there is no other transaction, is domestic TP applicable? My view, it is applicable. You need to show that this is a way to benchmark it. Is this, do you agree with it? Do you have different view?
One of them is that it is just a pass-through cost. It is not an expense payment. It is just like I have paid third party on behalf of it. My AE has paid on my behalf, and it is just back-to-back payment. So,
Can we just read, no, so can we read clause 1, any expenditure in respect of which payment has been made to 48(2)B covered entity? Has it happened in our case? Clearly yes. That's how I would read it. Exactly. So there is an expenditure. That's why I'm saying that there is an expenditure in the hands of the recipient company. First of all, TP will not apply because it's a receipt transaction. So you don't have 48(2) situation applicable. But anyway, some 3 or 4 interesting issues which may come up. Trade discount, fairly simple. 48(2) doesn't apply to trade discount, so you don't have a domestic TP applicability to the trade discount situation. Sales to sister companies. Let's assume both are tax-paying units and not a tax-holder unit. Again, domestic TP is not applicable. I don't know why, but even this point was debated, and there are few case laws which I mentioned, which we reported on Tax Sutra, that tribunal actually had to specifically rule that on the income side or on the receipt side, TP equivalent or fair pricing is not applicable. But you have those debates. So again, just out of completeness, I've mentioned. Third point is very interesting. Depreciation. So let's take a situation that I purchase a machinery from my parent company. Both are Indian companies. So I purchase a machine from my parent company and I claim a depreciation on that machine. Is specified domestic TP applicable? That's the question. Let me again show the section to you. That's a question. So is sure. So I'm not on 43A1. That is independently of my limited question is specified domestic TP applicable? Which means that let's take a situation that I have imported, I have bought a 10 crore machinery from my parent company. There is no other transaction. Am I liable to comply SDT? So that is a question that comes, that is a determination to be done later. First question is SDT applicable? If it is applicable, then I have to decide whether it is at arm's length or not. Right. No. So okay. Let me further complicate this situation. Machinery cost is 1 crore. I buy it from my parent company at 10 crore. Is SDT applicable? And I'm claiming depreciation on this. Yes, you have a thought. Sure. So I'm maybe a step before that. Do you have to apply either of the two, depreciation or machinery? In international transaction, yes, you have to apply clearly. There is no doubt. In SDT, do you have to apply? No. How many believe SDT will not apply here? Minority. So rest believe that SDT is applicable in this situation. Okay. So there are judgments. So first of all, there are two transactions that are taking place here. One is the purchase of machinery, and second is claim of depreciation. Now, purchase of machinery is not an expenditure, right? Unless that is a machinery purchased by a R&D unit and it is claiming a accelerated deduction or a weighted deduction under section 35, in which case I am claiming a capital expenditure as a deduction, or so that expenditure is being claimed. In a normal situation, otherwise, purchase of machinery is not an expenditure. Now, second aspect is depreciation an expenditure? And here we have all these famous case laws over the years which have consistently held that depreciation is an allowance, it is not an expenditure. Very recent expenditure being Vishnu Anand Mahajan, who happens to be a leading chartered accountant from your town, sir. Yeah, so there in this judgment, 14A is main issue, but the judgment also talked about, yeah, in the context of 14A, whether 14A applies on the depreciation. That was the issue before the special bench of the tribunal, and tribunal said that 14A is applicable to expenditure and depreciation is an allowance. So therefore you will not be required to invoke 14A disallowance for depreciation. The similar logic can even be applied in the context of domestic TP as well. So as far as 40A2 is concerned, the purchase of machinery will strictly not fall under SDT, but under ATI 8 or 10 situations, ATI 10 situation, perhaps or not perhaps, this transaction will be subject to SDT. So if the entity which is purchasing the machinery is also eligible for tax holiday, then you will have a situation where, owing to the close connection, are you generating profits more than the normal profits? So that is yes. We are dealing 1961 Act for the time being. Right, so there are several provisions which are new in DTC which are not there today. At least my view on this is that you should look at the law as it is today and as it is presently applicable, and as per that, this kind of a transaction is not covered under SDT. So sure. Sure. Sure, but again, my point is that the way 92BA reads, it says that any expenditure to a person covered under 48(2)B. It does not anyway say that you have to first satisfy in whether 40A is invoked. No, but the point is that 92BA still reads that any expenditure. So first it has to be an expenditure. Buying an asset, well, there are. Is it a capital expenditure? Okay. Sure. So it's a very interesting thought that is expenditure means a capital expenditure or revenue expenditure. As long as it is an expenditure, it is covered under 48(2), any expenditure. So therefore, capital is also included in that. So if it is a revenue expenditure which I have claimed and it is an expenditure, to that extent it will come in the SDT compliance. In capitalize, okay. Right, right. Interest capitalization, for example, yeah. Uh, uh, you're, okay, so very good point. Let's go back to 92. Any allowance for an expenditure or interest in relation to specified domestic transaction. So again, the question is that is this a specified domestic transaction? Because you could have an allowance, as I said, depreciation could very well be tested in the context of ATI 10 situation. Right. In relation to a specified domestic transaction. So uh, uh, anyway, the point is that the jury is out on this point. My view is that you can take an argument on this point that SDT is not applicable. Practically, what should be done can depend on the if you are anyway benchmarking, you might as well benchmark the depreciation, or in case of machinery purchases from associated enterprises, you can on the you can justify the valuation, etc. Maybe for excise service tax point of view, you could justify the value. So all that can be used. Pure technically, if I have to argue, I feel it's a defensible argument. Last two questions on this point, because it's about 1:05, 1:10. So another 5-10 minutes. Do we have? 10 minutes. Okay. Yes. Two questions on this point, and then we'll proceed. If I wear a consultant's hat and if I were to advise it, I will say that we should benchmark it. Yes. No, I have not changed. I am saying if I read the law and if I have to defend it, this is what this is my technical view. You asked me to wear a consultant's hat, which I am wearing and giving you answer. Though I am not a consultant, by the way, so. Right. Right. So very interesting point that she's raised is 3CEB disclosures around domestic TP. It says that any expenditure covered under 48(2)(b. Right. So there are 3 or 4 clauses in 3CB. The last clause says that any other transaction in 3CB. So if you are a transfer pricing officer, you can very well argue that there could be a counter to this, that 3CB is not a so you could have reported under this. Even under the international TP, the same point came up when initially depreciation, whether to benchmark or not, was an issue on this point. You had question. Yeah. Sure. I agree, that's a good point to defend that depreciation is not subject to SDT. I'm saying even the similar argument was there in the context of international TP, but there the point is that should you benchmark the purchase per se, and in the international TP there is a clear view or answer. I take your point that for the purpose of section 43, this transaction would need to be tested by AO. So point fully taken. What if AO has not done it? Can AO invoke a penalty for non-maintenance of TP documentation? Is the question that is to be tested, which is what our friend here asked, that would you do that? And that's why I'm saying. So one is that a legal provision, we should read it independently. Sure. Yeah, but on the penalty, so there you will have to demonstrate the reasonable cause of the interpretation, etc., etc. So your point is taken that this is a good argument to say that depreciation, purchase of asset is not covered under 4092BA type of a situation. I'm saying, but fundamentally, domestic TP, there will be several conflicts. I mean, let's take a situation of a ATIB builder. For him, purchase of land from a related party, you could have similar conflict. And maybe in tomorrow's session, you can raise this debate that purchase of land, will you apply ATI 10 and therefore SDT, or will you apply stamp duty valuation? Stamp duty valuation is specific, but at the same time you have no, last year's budget introduced a change which also 43 CA provision. So there will be several such conflicts between SDT and other provisions. As the law progresses, evolves, we'll have to see how it pans out. No, which is what I'm saying. No, I'm giving a counter to his point also, that just because stamp duty, which is a specific provision, does it stop AO from invoking an arm's length price for ATI 10 or a fair price? Maybe no. Two more situations on 48.2 that we will deal with it, and then we'll close the discussion. One is the intra-group funding and the director's remuneration. First, I will touch upon the director's remuneration, which has been a hot topic last year. So here is my question. Those who raised hand initially and who've done 3CB compliance of SDT last year, did you encounter director remuneration as a transaction? Okay, how did you benchmark, sir?
I have used the other method.
Okay.
And I have taken the resume of the directors, and I have given the resume to the HR company and asked him, what, if you see this resume, do you believe what would be the probable amount for as a remuneration?
Right.
They have submit me after seeing the resume that this amount, this director should be qualified for 40 lakh to 50 lakh or 1 crore to 1.5 crore. So after collecting 2-3 quotations from different HR companies,
Right.
then I have taken a view.
Right. Very interesting. So here the issue is that 48.2, director is a party covered under 48.2. Many companies pay salary, remuneration, commission to the directors, their relatives. Typically in a privately held companies, you have family members as directors, so wife also gets remuneration, etc. Very common. And this is a transaction which is covered under SDT. So now you have to decide the arm's length price of salary paid to wife of the director or a promoter. And what benchmark do you apply to arrive at the arm's length price? Which method will you apply? Cup? The salary that, the money that Reliance pays to Kokila Ben, how will you apply cup for that? Maybe in many situations, or even Mukesh Ambani's salary, can Reliance apply cup for salary paid to Mukesh Ambani? Not possible. Look at any other methods. Perhaps, at least from last year's experiences that I heard and what I saw, is that two or three approaches are being used. One is that include the director's remuneration in the overall benchmarking. I'm sure there are other transactions as well. And in benchmarking those other transactions, you apply entity-wide transactional net margin method, or TNMM, and director's salary or salary to the relatives of the director is also part of this. And if I am meeting the overall TNMM arm's length range, then I conclude that even the director's remuneration is at arm's length. So this is one safe approach, and which many companies have adopted. A lot of MNCs too have been subjected because of these situations, because their directors become Indian residents for tax purpose, etc. So that's one approach. Second, as our friend shared, some of the medium to large companies actually commissioned HR study or a benchmarking study by giving the resume and trying to get some independent assessment from the market that a person with so and so qualification and abilities, how much he will draw. Luckily, we have a sixth method which says that you can look at the price which would have been paid. So this HR benchmarking could get covered under sixth method. When we did not have sixth method, this would have been a major challenge because this is strictly not a cup. So this is a second approach, HR benchmarking, external benchmarking that has been done by the companies. On a lighter note, at a CII event in Delhi, one of the directors from the company who was on the panel on domestic TP, he said that I'm a director, finance director. So to apply cup, what I will do is I'll go to my competitor, show him CV, get a offer letter, and that becomes my cup to justify. And he also said that you go to any director and ask him that is the salary paid to you sufficient. You, you will always be subjected to a domestic TP adjustment, especially in a ATI 810 situation. So this is on a lighter note. So these two approaches, and I've seen some companies also specifically mention and take a view that this is a revenue neutral transaction as far as income tax department is concerned. See, you look at expenditure payment to a group company, right? You could have a situation that group company is reporting losses, and therefore there is a shift of losses that happens by booking this expenditure. In case of directors, however, the remuneration that a director earns from a company is taxable at a normal personal tax rate. We are looking at a transaction value of more than 5 crores, so reasonably large size transaction. There, invariably director would be paying minimum 30%, and if the salary is more than 1 crore rupees, even 10% additional surcharge. So where is the question of revenue loss to the government? A company, no, let me just complete. I'm sure there are counters. If I pay 5 lakh rupees to a wife of director who's, then you may not pay tax. I'm saying those are but extremely small situations where revenue impact is not significant. If you look at the material aspect, you may argue that there is a revenue neutrality in this case. In fact, some companies have also actually said that many times this director's remuneration is subject to TDS. So they are able to also demonstrate that the relevant taxes on this have been paid. So don't subject us to this unnecessary sort of compliance burden. And they have in the TP study benchmark as a primary approach, saying that this is a revenue neutral transaction, this is what Glaxo said, this is what the memorandum is stating, and therefore we are not doing a benchmarking, but here is the approach that there is no revenue loss. So I have seen all these three approaches. Yes. Right. I think this can be a very good persuasive value, but as we know that in assessments you don't have a res judicata, which means that your previous year's conclusions may or may not necessarily apply in the current year. So I'm saying but so it is possible argument. If you ask me, technically you have to meet the arms. Sorry. But here it's the same. Yeah, so possibly a sixth method, if assessing officer has specifically examined in the earlier year's salary, just by saying that, you debited it and it went through normal assessment, it's like, your 147 principles perhaps may come into picture. If officer has made a specific application of the mind and has said, perhaps, yeah, that's a good sixth method, that last year's assessment order is my benchmark by applying a sixth method possible. Now, on this point, just to share, there's one lady, Ms. Batsala Yadav from the CBDT, who's been made in charge of the domestic TP from the revenue side. See, fact is that if you speak to the officers, for them there is still time away before this comes up for the scrutiny or assessment. So, department so far has not started putting together infrastructure and approach around domestic TP, but there is a person identified within CBDT to take care of domestic TP, and director's remuneration was a specific point that almost everybody raised, and she acknowledged that it probably doesn't make sense to put a onerous compliance burden of SDT for directors' remuneration. In fact, before November, they were working on a clarificatory circular clarifying certain aspects of SDT, which unfortunately could not see the light of the day at that time. Hopefully, before this year's compliance in November, we will have some clarification, at least on directors' remuneration point. That's a hope. So this is just additional point. Yes, sir. Sorry? Neutrality, yeah. Revenue neutrality, yeah. Right, but you are looking at a converse situation, sir. Here, we are seeing that whether, let's say, if the 1 crore remuneration that a company paid, should it have, no, point taken, sir, that you could have a DDT. I take your point on the principles of revenue neutrality, and that's true even in case of transfer pricing adjustment, the international TP adjustment. Not just domestic TP. Let's take a situation where you do a voluntary TP adjustment. Let's say I have a captive subsidiary. I'm digressing from SDT, but let's say I have a captive subsidiary. My entire shareholding is held by my foreign parent. Let's say my monthly expenditure is 5 lakh rupees. I only get a reimbursement from my foreign company to meet the expenses. That's it. At the end of the year, when I file my tax return, my annual expenditure is, let's say, 60 lakh rupees. I say that I apply safe harbor, 20% is the profit margin that should be added. So I say that I pay tax on 12 lakh rupees profit. So I get money to pay the tax. Only in my return of income, I show 12 lakh rupees as income, but don't get that money actually. This is a classic situation where you are actually avoiding dividend distribution tax in India. But today, there is no law in India to take care of the DDT taxation. And to tell you specifically, certain European countries actually have a secondary adjustment on TP adjustment, which is for the dividend foregone or tax on dividend that is foregone. So the moment there is a TP adjustment that is done, it also results in a secondary adjustment of tax on dividend that is foregone. India so far has not reacted to this. Well, all right. We'll end at least on this point here. Any other perspective? Yeah, so last bullet was on the partner's remuneration. As you all know, partnership, when it makes a payment to the partners, there are slabs specified according to the total income of the partnership. You arrive at the permissible salary. The question is SDT applicable to this? Now here the general specifics, etc., whether it is an expenditure allowance, etc., will apply. There have been several judgments in the past which said that partner salary, which is specifically allowed under 40B, is not subject to 40A2. This is pre-SDT era. Okay, so okay, I did not note the circular, but perhaps some circular was also there. Again, if we apply the test, or if you look at the definition under 92BA, expenditure, 2 persons covered, etc., etc., it seems to get covered. So the question is that, is SDT applicable? Yes. The question is that, how do you benchmark? Perhaps then there you could bring in these arguments around case laws and the fact that your payment is as per 40B limits. Again, this is not free from doubt. Someone can say that 40B limit is not arm's length price or a fair price. But I'm saying the law specifically allows me to do only so much. I can't pay beyond that. So where is the question of, it's like royalty benchmarking. Government in good old days had 5% and 8% limit. So I could not have paid more than what is allowed under the law. So in Rule 10, during benchmarking, while deciding the arm's length price, I have to see the other laws and effect of other provisions. You can't force me to do impossibility. So that could be one argument on the partner's remuneration or salary. So very quickly on this point, very small point, but you will understand the relevance of it. Two situations, entity A, entity B. Entity A has given loan to B and B has paid a interest. Let's say the rate of interest at which entity B has paid is 12%, and let's say arm's length price is 8%. Now, this is a classic case of 48-2 where in the hands of entity B there is a 48-2 disallowance. Look at a situation 2 where there is no interest that has been paid by entity B to entity A. So, sorry, it's not a, you could take a loan transaction. I've taken a guarantee transaction. There is a guarantee, but no guarantee fee that has been paid. Same could apply even in respect of interest. Now, here, because the way the sections are worded, entity B, there is no expenditure in its books. So, where is a question of applying SDT? So, this is contrary to what we learned under the international transfer pricing. One of the biggest challenge today, or one big area open for debate today under SDT, is that what if I have not charged anything to my company or a foreign to my associated entity. SDT today at least refers to actual expenditure and the value as recorded in the books of account. So if I have not, especially in the ATI 810 situations, if entity A is reporting is claiming tax deductions under ATI 8 or 10, even this transaction could get triggered, but not in a 48-2 type of a situation. So this is just one takeaway. So even the guarantee fee debate that we studied in the earlier session could be applicable in case of domestic TP where entity is claiming a tax holiday. So this is just one takeaway. I will same threshold as partner's salary, sir. I think that's what should apply even for the interest to partners. I would think it's not covered. Payment in kind, as in there is no transaction which you have recorded in the books and you just.
So in a situation where there is a development agreement between two related parties, and in a situation where there's a development agreement between two related parties, and the company developing the property is giving him constructed area for
Right.
so
Get
in
your
that
point. Yeah. My view is that it is a transaction which is covered under 48(2)(b). Let me again read 92(ba). Any expenditure in respect of which payment has been made or is to be made. So has been made certainly is not the case, but is to be made. So you're sort of discharging the consideration in kind. That's the situation. In case of a developer, this cost of development that he has that he has incurred and
will be the consideration.
Yeah, will be considered. So again, we are as far as the 48(2)(b) is concerned, the cost for him is the construction cost, for which the payment has been made to not to that party, but to my vendors, etc. So okay, let me sort of rephrase my answer. In that case, if it is a 48(2) type of a transaction, I feel SDT will not apply, because here there is no expenditure or payment to that party. In fact, I have discharged the consideration by way of a issue of by way of allotting a particular area, which is a revenue side transaction not covered under domestic TP. But if I am a ATIB, if I am a developer claiming section ATIB deduction, in that case, whether the fair value of the property that I have allotted, whether I have brought it to tax in the books of account, can certainly be tested under SDT. So a 48.2 type of a situation, I feel this transaction development agreement is out. But in case of ATI 10 situations, and if the developer is claiming ATIP deduction, perhaps SDT will apply. That's my view. I feel so, yeah. So this is a question with which we started. I'm sorry I've exceeded my time by 15 minutes or so, but is 92BA independent of 48.2? That's a question. I will. Any quick comments on this point? Based on what we studied. Right. Any thought? Yes.
Whatever is included in the limit of 5 crore, it is not at the market price or it is not at the reasonable price. So 92BA is independently applicable. So it's a separate section.
Yeah, so I'm not on a transaction below 5 crore. I'm really not talking about it. Let's say if there is no 48.2, can you still, 48.2 disallowance is not there, but can you still apply 92 and 92BA? And I'm, as I said, coming to a Shell or a Vodafone type of a situation where share issue transaction is there and your unreceived premium is being sought to tax by claiming that section 92 is an independent charging provision. In fact, department in its argument before the High Court has said that transfer pricing is a sixth head of income, section 92 adjustment, and therefore independent of whether income exists or not, there should be a TP adjustment should be taxed. That's the point. I'm sure after 10 years, maybe again here we'll be debating on similar situation in the context of domestic TP. Thank you so much for the patient hearing. Thank you.
Dear friends, our learned speaker has very well articulated the provisions of domestic transfer pricing and on international transfer pricing, and he has very well deservedly articulated the difference between both. And I would appreciate that if everybody join me to give a very round of applause. Okay.